One of the questions that I often get from clients is, what are the tax implications of life insurance? Now, if you're like most people, you've probably thought, well, life insurance, it's not taxable. There's not really anything to do with tax with life insurance. However, there are various different tax consequences depending on what type of transaction you're doing, whether that be paying the premium or maybe the life insurance payout or maybe transferring the policy. There are some things that you need to know about life insurance when it comes to taxes. And by the end of this video, you'll know everything, well, almost everything, 90%, 95%, all the important things that you need to know about life insurance and taxes. What is up, guys? For those of you new to the channel, my name is Philip Sutter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting, I'll put a link in the description where you can book a one-on-one meeting with myself and we can discuss your needs. But without further ado, let's get right into the video. Now, there's a few different variables that you need to be aware of when thinking about life insurance and taxes. The first one is it term or is it permanent life insurance? So that's the first thing, because both of those have different tax implications. The second one is it owned personally or is it owned corporately? Because those two things have different tax consequences. Now, there's 4 different financial transactions with life insurance that may trigger some type of taxable event. The first one is paying the life insurance premium. The second one is receiving the death benefit. The third one is cashing out your life insurance policy. And this is specific to permanent life insurance. So what I mean by this is canceling the policy. I no longer want it. Just pay me my cash surrender value and let me go on my way. And the fourth one is transferring ownership of a life insurance policy. And we're going to get into all these different transactions and how tax affects them. Now, like I mentioned at the beginning of the video, there's a couple of different variables that you need to be aware of. The first is term versus permanent. So first of all, let me just quickly explain that real quick, just in case you're not aware of it or you missed it or you want a refresher or whatever it is, okay? Term life insurance is the easiest type of life insurance to understand. You can pick a term, maybe term 10, term 20, term 30, or even term to 100. This is essentially a contract that you pay for the specified amount of years. Now, you don't have to, of course, you can cancel at any time. However, the premiums are fixed for the duration of that term. At the end of the term, you can usually either cancel the policy because you no longer need it now, you're older, your debt's paid off, your house is paid down, your kids are out of the house, whatever the reason being, you can cancel it. You can usually renew it. Most insurers have the option that you can renew it. So if it's a 10-year, it would renew for another 10 years. If it's 20, it would renew for another 20. The third option is, most carriers will have this option, is you can convert it. So if it's a term life insurance policy, maybe you had that from age 25 to 55. Let's say you had a 30-year term. Maybe at 55, you say, okay, I don't really need this term anymore, but I want to convert it into a permanent life insurance policy. And maybe your health has declined at that point. That's fine, because with this conversion option, again, that most carriers have, you can just convert it right into a permanent life insurance policy, assuming that they have some type of permanent life insurance policy. And it doesn't matter what your health is. They have to allow you to convert it, again, if that carrier has that option. That's term life insurance. I think, in my opinion, it's the best option for the majority of Canadians, because again, we get life insurance to protect our loved ones, dependents, children, partners, maybe aging parents. And usually that need is a need for a specific period of time. Your kids are growing up, you have a mortgage, you and your partner are working. If one of you were to pass away, there'd be a lot of extra financial responsibilities for the other partner. Usually that's a period of time in your life. Hopefully, as you get older, you start to pay down a lot of your debt. Your kids grow up. Hopefully they leave the house. Maybe they go to university. Maybe they get a job. Hopefully they're not in your house forever, in your basement, freeloading off you for the next 50 or 60 years. So the need for life insurance ends and you can cancel your policy. You no longer need it anymore. Now, permanent life insurance, on the other hand, this is where there's 2 different options. We have whole life and we have universal life. And this is where it's coverage until the very end. And now with permanent life insurance, this is really where you have the conversation of estate planning. So maybe we have some type of estate taxes that we need to take care of upon death. Maybe we have some other properties and there's going to be a tax bill and we want some liquidity upon death. Permanent life insurance could be a very good option. Maybe we want to leave something behind to the next generation and we want to do that in a tax efficient manner. Permanent life insurance option, again, it can be a very good option, but there's always that conversation about maybe you should invest in life insurance. Maybe you should, put this away and you can use it for retirement. You can borrow against it and you can leverage against it. Now, if you go on my channel, I've made dozens of videos and I'll be making dozens more of videos about this topic. However, in short, at the end of the day, I believe that using permanent life insurance as some type of investment is a poor investment for the majority of Canadians. It can be a really good investment for the high income earners where tax is the variable that makes this type of strategy more applicable. However, I think for the majority of Canadians, low to middle income earners, they should focus on other strategies as an investment, such as your TFSA, your RRSP, maybe real estate, some other type of investment that is just tax deferred or tax free, like those registered accounts, and maybe focus on this type of strategy later once those accounts are utilized. However, if you're a high income earner where you've already started to utilize those and tax is a variable, it could be a good idea. And if you're a business owner, it could be a great idea because there's a lot of special tax attributes that come along with it. However, that's not what this video is about. This video is about taxes and taxes on life insurance. So let's get back on track. That's term versus permanent life insurance. And the next two I wanted to talk about was personally owned versus corporately owned. Now, personally owned life insurance is very straightforward. It's easy to understand. You as the individual own the life insurance, you're the payer of the life insurance, and you have a beneficiary. However, with business-owned life insurance, maybe you're a shareholder in a corporation, maybe you run a small business like a CCPC here in Canada, Canadian-controlled private corporation. We love our acronyms. And you're 50% shareholder or 100% shareholder, and you're making money in your business. Well, putting the life insurance in the business could be a really good way to save on taxes because the business tax rate is quite a bit lower. In this scenario, the business is going to be the owner, the payer, and the beneficiary of the policy. You're just going to be the life insured as the shareholder. So that's two different ways to structure it, and the taxes are different depending on which one you're in. So the first transaction that we're going to get into today with taxes is the premium. Can you deduct the premium? Now, I have loads of clients ask me this question all the time. They say, you know, is it a write-off? Can I deduct it against my income? Can I deduct it in the business? Can I deduct the premium? Now, here's the thing. Whether it's personally owned or corporately owned, this is going to be the same. Life insurance premiums, 98.5% of circumstances is not tax deductible. However, there is one very unique scenario in which a portion of the premiums can be deductible. And when that is if a loan is conditional upon you purchasing life insurance. So what I mean by that is you go to a bank and they say, yep, we'll give you this $500,000 loan or $1 million loan. However, as a condition of the loan, and they need to stipulate this and write you basically a document stating that you require life insurance on this loan. It's not just something that they offer. It's not just a nice to have. It's a requirement of the loan, okay? Then a portion of the premiums known as the NCPI, which again, we love our acronyms, the net cost of pure insurance. So that's not the actual total premium. That's just the specific cost to the insurance company. So with term life insurance, that's usually going to be the majority of the premium. However, with permanent life insurance, it's going to be very, very, very little because it's actually just the true cost, basically the base cost. What is the actual insurance costing the insurance company? So, you know, maybe if it's term life insurance on a $100 premium, it might be, you know, $60, $70, something like that. On permanent, it might be way, 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 way less. Okay. So a portion of it is deductible if the requirement of a loan stipulates that you have to have life insurance. And again, it's the same whether it's corporate or personal. This very, very, very seldom happens. You need to write to the insurance company and get what the NCPI is, the net cost of pure insurance. It's not something that happens very often. However, this is one of the ways that you can deduct it. Number two, receiving the death benefit. Now, you would think, oh, this is pretty straightforward. I mean, they always say life insurance is tax-free. Is that not true? Is it taxable? Here's the thing. Personally, whether it's whole life insurance, universal life insurance, term life insurance, the death benefit will always be 100% tax-free. So if you own the policy personally, you pay for it personally, it's going to be tax-free. You have nothing to worry about. The second one, however, though, is owning life insurance in a business. Now, here's the thing. Life insurance in business, like I mentioned, is the owner, payer, and beneficiary of the policy. So you might be thinking to yourself, okay, well, if the corporation is the beneficiary, then the corporation gets paid the death benefit. How does that work? Here's how it works. There's a little bit of a formula you need to know. Don't worry, it's not that complicated. However, in a corporation, there's a special attribute known as capital dividend account. And all this is a notional account where you can pay tax-free dividends to shareholders. I don't want to overcomplicate this, okay? However, the formula for life insurance when it gets paid into the corporation is whatever the face amount is of the life insurance policy. So let's say it's $1 million of face amount minus whatever the adjusted cost basis is of the life insurance policy is going to equal your CDA credit. And what that means is that's what you get to pay out to the shareholders tax-free. How do you get it out of the corporation? Tax-free. So with term life insurance, it's very easy to calculate because there is no ACB with term life insurance. So if you have a term life insurance policy in your business, $1 million face amount, zero ACB, well, $1 million minus zero is still going to be $1 million. The corporation would receive $1 million and then they would receive a correspondent $1 million capital dividend account balance, meaning at any point they can pay out $1 million tax-free any of the shareholders. So million in, million out, it's all tax-free, everybody's happy. With permanent life insurance, it gets a little bit more complicated, and I don't want to overcomplicate this video. However, all you need to know is in the early years of a permanent life insurance policy, the ACB will start to rise. So maybe it'll go from 100 to 200, 250, 300,000, 350,000, 400,000 as an ACB, let's say with $1 million death benefit. So if that were to happen, the corporation would still receive $1 million. However, it would only have, let's say, $400,000 ACB. So it would only have 600,000 of a capital dividend account balance to pay out to shareholders. At the end of the day, they would still have another 400,000 in the corporation. They could pay out as taxable dividend. They could use it in the business. They could do whatever they want with it. However, there would be that amount that's still in the corporation that they would have to figure out what they want to do with it, pay taxes or leave in the corporation. Now, as you get older with a permanent life insurance policy, the ACB will start to go down, and hopefully you live a long and healthy life and you die when they expect you're going to die, usually around that 85 to 90 mark. In that case, the ACB will probably be ground down to 0 and you will receive the full CDA credit, and you can pay, well, you'll be dead at this point. The corporation can pay out that benefit to the shareholders, whether that be your estate or other shareholders or a partner, maybe a wife or a husband that's in the business. They can pay that out 100% tax free. The third transaction that we're going to talk about today is cashing out a permanent life insurance policy. So like I mentioned, term doesn't have any cash surrender value or anything like that. Permanent does, whether that's universal life or whole life, it doesn't matter. There's still that cash value component. Universal Life calls it the investment fund or fund value, whatever they want to call it. So at the end of the day, let's say I'm done with, you know what? I don't want my insurance. I'm done with it. Give me my money, cash it out. By the way, this is usually not a great option, and I'll explain why here, is because the taxable amount is going to be whatever that cash surrender value is minus the adjusted cost basis of the policy. So if you had a cash surrender value of, let's say, $250,000 and you had an ACB of maybe, let's say, $50,000, well, you're going to have a $200,000 taxable amount included in your income, and that's fully taxable. So it's going to be quite expensive. It's going to increase your marginal tax rate quite a bit. By the way, if you're interested in taxes here in Canada, I made a video about that and you can watch it there. I'll put it in the, or I'll link it, pardon me, right there. So that's usually not a good idea. And this doesn't matter whether it's personally owned or corporately owned. If you cash out your life insurance policy, it's going to be whatever the cash surrender value is minus the adjusted cost basis of the policy, and that is going to be the taxable amount. The last and final financial transaction or transaction that I'm going to talk about here is transferring ownership of your policy to someone else. Now, this is usually not going to happen on the personal side very much. There are a few cases where it could happen. You might be wondering, well, why would I own life insurance on the life of someone else? There are a few different scenarios where this could happen. For example, maybe you wanted to purchase some type of permanent life insurance on your child or on your grandchild. Well, obviously your child or your grandchild is not going to be the owner of the policy. Maybe they're younger, maybe they're 5 or 10 or 15 or something like that. And you want to be the owner of the policy while you're paying into it until they reach a certain age. And then you say, okay, I'm going to give control of this policy over to you. Another scenario where it happens, well, I should say we plan very carefully for it not to happen. However, it could happen is if you get life insurance in a business. Now, this is very important. If you have life insurance in your corporation where you're the life insured because you're a shareholder of the corporation, but of course the corporation is the owner, payer, and beneficiary. Let's say you want to sell the corporation. Let's say you wanted to wind up the corporation and shut it down and essentially at the end of the day, get rid of it. This is where you need to be very careful because a lot of taxable consequences can come from it. So I'm not going to get into every single different case and scenario where this could happen because this is actually quite a complicated area. However, at the end of the day, there are a few exceptions to this where they do allow you to transfer a policy without any taxable consequences. And a couple of those are, you can transfer a policy to your spouse using a spousal rollover. That can be tax-free. You can transfer a policy to your child or to your grandchild, assuming that they're the life insured. And this is allowed on a tax-free basis. One other unique scenario is if you have a trust and the trust owns life insurance, you can have the trust distribute the life insurance policy to a capital beneficiary. This can also be tax-free. However, in most other cases, it can be taxable. And so transferring a life insurance policy is not advised. It can be very complicated and it can be very, very, very punitive when it comes to taxes. One of the areas that I mentioned that it could come up and it could be quite punitive is in a corporation. So very careful planning needs to be done to make sure that if you do purchase life insurance in your corporation, you are going to keep that corporation. You're not intending on selling it. If you are intending on selling it, maybe something like an operating company, you're going to want to do some type of restructure and put that life insurance policy into another corporation that you are intending to keep until death. Because here's a quick example. If you tried to transfer it, maybe let's say to yourself personally, you said, okay, I'm selling this operating company. I've had this policy for a long amount of time. Keep it, pardon me, because I'm older now. It's built up cash surrender value. It's a permanent life insurance policy, but someone wants to buy the corporation and take it over. I want to sell it and I want to keep my life insurance policy because it's not going with the business. This can be very punitive because first, when you transfer a life insurance policy, there's a disposition of the policy at the owner's level right away. So the corporation would then receive a taxable event. And this is again going to be CSV minus the ACB. So they're taxed immediately right away. And then if you try to transfer the policy to yourself as a shareholder without anything in consideration, you will also receive another taxable benefit. And this could be the cash surrender value, but it also could be the fair market value, which might be totally different because maybe you have health conditions at this point and they say, well, the cash surrender value is 500,000. However, to replace this policy would cost like 2 million. So you as a shareholder might then receive a $2 million taxable benefit. So first the corporation was taxed $500,000, then you're taxed $2 million as a taxable benefit. This is very, very bad. You need to make sure you do very careful planning. If you're putting life insurance into a corporation that you intend on selling, you don't want to do that. You want to put it in a corporation that you intend on keeping for a very long time, until death, essentially, because you can't just transfer it as you saw. So with that all being said, I hope that I didn't confuse you more than I helped you. And I hope I answered most of your questions about taxes with life insurance in Canada. If you guys have any questions, feel free to drop a comment below. And if you guys are enjoying this content, all I ask is to give it a thumbs up and I'll see you guys in the next one.